Here's something that might shock you. Europe's second-largest economy just lost its prestigious credit status, yet the euro barely flinched. But here's where it gets controversial. Some analysts are saying this could actually be bullish for the European currency in the long run. France took a financial hit over the weekend when Fitch Ratings stripped away the country's AA- credit rating, pointing fingers at the government's mounting debt crisis. For those new to credit ratings, think of it like a report card for entire countries. When your grade drops, it usually means trouble. But here's the twist that's got currency traders scratching their heads. The euro's reaction was surprisingly muted. Trademark Monday morning saw the European currency slide modestly, dropping to $1.1725 against the greenback, while also surrendering roughly 0.2% against both the British pound and Japanese yen. Meanwhile, the dollar index retreated slightly to 97.5 against a collection of major currencies. Now, here's what most people are missing about this French downgrade story. According to Nick Rees from Monex Europe, financial markets had already anticipated this credit rating cut well in advance. It's like knowing bad news is coming before it officially arrives. The shock factor gets diminished significantly. This explains why we didn't see the euro crashing through the floor, despite France being such a crucial pillar of the eurozone economy. But wait. There's more brewing beneath the surface that could reshape currency markets entirely. This week brings us what many are calling a central bank bonanza, a parade of critical policy decisions from major economies that could send shockwaves through global markets. Wednesday's Federal Reserve meeting stands as the main event, with money markets betting their bottom dollar on a 25 basis point interest rate reduction. For beginners, basis points are simply hundredths of a percentage point, so 25 basis points equals a 0.25% rate cut. However, there's still a slim 6% probability that Fed officials might surprise everyone or with a more aggressive 50 basis point slash. Carol Kong from Commonwealth Bank of Australia raises a fascinating point that challenges conventional thinking. Fed Chair Jerome Powell would need to outdove the market with explicit hints about future rate cuts to really move currency needles. And this is the part most people miss. It's not just about what central banks do. It's about exceeding or falling short of market expectations. The policy divergence narrative gets really interesting when you consider that speculative traders are doubling down on euro strength. Net long positions against the dollar recently hit $18.4 billion as of September 8th, hovering near two-year highs. This suggests professional money managers believe the euro has more room to climb, particularly as Fed rate cuts become reality while European central bank easing prospects diminish. Mitsubishi UFJ Financial Group analysts are painting an even more optimistic picture, projecting EUR/USD could target the 1.200 level as policy paths between the ECB and Fed continue diverging. However, the pair currently finds itself trapped in a trading range between 1.1500 and 1.1800, a technical pattern that's frustrating both bulls and bears. Elsewhere in currency markets, sterling is flexing its muscles, advancing 0.3% to $1.3593 and reaching its strongest position in a month. Both the Bank of England and Bank of Japan are widely expected to keep their policy rates unchanged during their upcoming meetings, though market watchers will be parsing every word for clues about future moves. Here's where things get particularly intriguing for Japan watchers. Despite the yen strengthening slightly against the dollar to 147.47, analysts remain focused on BOJ commentary that might hint at rate hikes later this year. It's a delicate balancing act for Japanese policymakers who are trying to normalize monetary policy without crushing their export-dependent economy. But perhaps the most surprising currency story involves China's yuan, which managed to edge higher despite absolutely dreadful economic data. Monday's figures revealed that factory output and retail sales in August posted the weakest growth rates since last year. The kind of numbers that would typically send currencies tumbling, yet the onshore yuan strengthened to 7.1213 per dollar, largely thanks to broader dollar weakness. And this is where the geopolitical plot thickens considerably. U.S. and Chinese officials wrapped up their first day of Madrid trade talks on Sunday, discussing everything from strained commercial relationships to TikTok's potential divestiture deadline. Washington's pressure on allies to impose tariffs on Chinese imports over Beijing's Russian oil purchases adds another layer of complexity to an already intricate currency puzzle. Now here's my controversial take that might ruffle some feathers. Could France's credit downgrade actually strengthen the euro by forcing European policymakers to address fiscal discipline more seriously? Some market veterans argue that external pressure often catalyzes necessary reforms, potentially making the eurozone more resilient long-term. But what do you think? Are we witnessing the beginning of a sustained euro rally driven by Fed dovishness? Or will European fiscal concerns eventually catch up with currency markets? And here's an even more provocative question. With central banks globally seemingly coordinating their easing cycles, are we setting up for another round of competitive devaluations that could destabilize the entire international monetary system? The Norwegian and Swedish crowns also caught some upward momentum against the dollar, suggesting broader greenback weakness rather than isolated currency strength. This pattern often signals that investors are rotating away from safe haven assets toward higher-yielding alternatives, a trend that could accelerate if Fed rate cuts materialize as expected. As we head into this central bank decision marathon, one thing becomes crystal clear. Currency markets are at a critical inflection point where policy divergence, geopolitical tensions, and economic fundamentals are colliding in ways we haven't seen in years. The real question isn't whether volatility is coming. It's whether you're positioned correctly when it arrives. What's your take on this central bank chess match? Do you believe Powell and company will deliver the dovish surprise that Euro bulls are counting on? Or could we see a more measured approach that disappoints those betting on aggressive easing? Share your thoughts and let's debate whether this French downgrade story is just noise or a genuine signal of deeper European vulnerabilities ahead.